Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we will be doing technical analysis on the S&P 500 for Friday, May 22nd, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Today we were up 24 basis points on the S&P 500 and closed at 2955.45. The first chart that we're going to look at is a 10-day, 10-minute chart of the S&P 500. So each candlestick does represent 10 minutes of trading. And what we can see here is for today's trading, and of course the dotted blue line is where we finished up yesterday, where we closed yesterday. But you can see here we gapped down at the open and we traded negative for a good portion of the day, and then we're finally able to go positive around 2 o'clock this afternoon, and then dipped into the negative for a few minutes here after 3, and then finished up again 24 basis points for the day, and again closing at 2955.45. Now for the week, as we can see here, we gapped up at the open on Monday, and for the majority of the week we've really just been going sideways, as you see here. So not a lot of progress made for the week, except on the gap up on Monday's open. The other thing we can see here on this chart is this blue line. This blue line I have set at 29.45. And I wanted to show that on May 11th, the intraday high was 29.4425. So I just drew the line at 29.45 so you can kind of see that. From the intraday high on May 11th to where we close today, the difference is 11.20 points. That's it. So in 10 days, we've really only made 11.20 points of progress on the S&P 500. Now, for the week, it looks good because, of course, we sold off last week, hit that 27.66 intraday low on the 14th. And so because we had a negative week last week, it made this week look good because, you know, you bounce up, you get that positive reaction and that gap up on Monday. So the stats look good for this week, but the reality is when you go back 2 weeks, we really haven't made a lot of progress in the last 2 weeks. And then if you didn't see last night's video, I would highly encourage you to watch that because I did some 20-day, 30-minute charts where I showed we really have not made a lot of progress in the market since April 29th. So if you didn't see last night's video, please watch that as well because that has some shorter-term charts on it, and that'll give you some more perspective in looking at the last 20 trading days. Here we're looking at the last 10. This next chart that we're going to look at is a 5-year weekly chart of the S&P 500. So each candlestick represents 1 week of trading. And the blue line is the 40-week moving average, which is equivalent to the 200-day moving average when you're looking at a daily chart. A lot of people use the 200 or the 200-day or the 40-week moving average in their work. I don't use it in my model or anything like that, but I'm using it on these charts to illustrate a point, and because regardless of what charting service you're using across the globe, whether it's Yahoo Finance or whatever, you can always use the 200-day or the 40-week moving average. It's a pretty standard moving average that has been used for many, many years. But what we can see here is you were really not in an uptrend on the S&P 500 until you were above this 40-week moving average. And as we can see here, we still cannot get above the 40-week moving average on the S&P 500. So in my mind, we're still not in a long-term uptrend on this index. Now we're going to look at a 5-year weekly chart of the DIA, which is an ETF that tracks the Dow Jones Industrial Average, for those of you that like to look at the Dow. And what we can see here is we're still well below the 40-week moving average on the Dow Jones Industrial Average. You know, there's still a lot of weakness in these markets, guys, and the Dow is trading about where it started 2018. So where we're at right now, pretty much where we've been since the beginning of 2018 on the Dow. And now we're going to look at that same 5-year weekly chart. This time we're going to look at the S&P 400 mid-cap stocks, and we're going to use the MDY ETF for this analysis. And what you can see here is the mid-caps, the S&P 400 mid-caps, are trading well below their 40-week moving average. And on this index, you can see that we're clear back into 2017 trading. So The S&P 400 mid-caps are trading where they were in the middle of 2017. So again, still a ton of weakness in this stock market, guys. The mid-caps and the small caps, which we'll look at next, just have not been able to keep pace with the large caps over the last couple of years. That is not a really strong market. And now we're going to look at the Russell 2000 small caps in that same 5-year weekly format. And we're going to use the IWM, the ETF that tracks the Russell 2000 small cap index, for this analysis. And what we can see here is we closed just beneath 135 on the index this week, technically closing at 134.83. And we're well below the 40-week moving average on the Russell 2000 ETF. And you can see that the Russell 2000 ETF, just like the MDY, is trading at about where it was in the middle of 2017. The other thing of note is that the Russell 2000 small caps actually peaked in August of 2018. We can see here on August 27th of 2018 for that week, the IWM closed at 169.05. That is the highest weekly close ever on that ETF. You can see that we did a double top here. We got back and really got close to those closing highs at the beginning of 2020 here, but forming that double top, it actually failed, and we had a slightly lower close in January of 2020. And so we had a double top. Again, that's a bearish formation. We had a peak in these small caps back in 18, almost 2 full years ago, August of 2018. So, guys, we've seen weakness in these markets for several years. One positive here is the small caps had a pretty good week, up 7.80% for the week, where the S&P 500 was only up 3.20%, okay? So we are seeing a little bit more strength in the small caps, again, up 7.80 for the week. The mid caps were up 7.31 for the week. So I want to be fair about this, that they had a pretty good week, the small and mid caps, compared to the large caps. The DIA was up 3.36% for the week, and the SPX, the S&P 500 index, was up 3.20% for the week. But as we know, when we look back over a longer time span, again, the week looks good because we had the sell-off last week, right? So it gives us a lower starting place. But when we go back and we look over the last 10 days or the last 20 days by going back and looking at last night's videos, what we know is we just have not been making a lot of progress in the stock market for the last month. Now what we're looking at is a chart of 2018, and I have this annotated with the Simple Market Signals signals. So these are the weekly signals that come out and are published in the newsletter. And so what we can see here is the signals, the Simple Market signals are green, yellow, and red. So I'm just going to go through this very quickly. We're going to take a look at a couple of charts, but I want you to understand how these signals work and how they can help you. So first off, we have the green signal, and the green signal is the best risk-reward signal for equity investors. And what you're going to see here is that most all upward progress in the stock market is going to be made when the signal is green. And then we have the yellow signal. Now, the yellow signal indicates change, and generally what happens is after a green signal environment, then the signal will change to yellow, and if the sell-off gets bad enough, it'll change to red. Now, in this time frame here, we had both yellow and red signals. I just kind of clumped those together just to kind of give you an indication of what happens. It's very, very hard to make money in the stock market when the signal is either yellow or red, okay? So again, most all of your upward progress in the stock market is going to happen in the green signal environments. During a yellow signal, you're either going to be sideways to slightly down is kind of the realistic expectations, but oftentimes that yellow signal will be that transition signal between a green signal environment and a red signal environment. So in 2018, we went green, we were green here, and then the signal went yellow here, and then it turned red, and we'll take a look at that here in just a second. The red signal is your worst risk-reward signal for equity investors, and your worst downturns, including bear markets, happen during a red signal, and we'll take a look at this here in just a second. Now, let's focus on this time frame right here where the signal went yellow, and we're going to switch to a chart that's going to straddle from September of 2018 through March of 2019, because I want you to understand what happened here. So right here, right, we had this green period, and then the signal went yellow here. And so what we're going to do is go over here. So right here is where that signal went yellow, all right? And then a few days later, the signal went red right here, and that was in October of 2018, as you can see down here. And then we had some sideways choppy movement, and then a quick sell-off. We bottomed right here in the latter part of December, and then the market started a rally. Now, a couple of things to understand is the market will bottom during the red signal, okay? Because again, remember that simple market signals, the weekly signals, measure risk levels in the stock market. So green is your best risk-reward ratio for equity investors. Red is the worst risk-reward signal for equity investors. And a yellow signal indicates that there's change, that risk is rising, and sometimes that risk gets bad enough that that signal goes red, okay? But anyway, so we bottomed here. The market started to go up, and we can see here that the signal went back to green right here. During shorter red periods, oftentimes the red signal and the green signal come out at about the same price level, okay? And I'll show you here on another chart in just a minute that the longer the sell-off, the lower that green signal is relative to where the red signal came out, and that'll make sense here in just a second. But again, this is just based on market metrics and market internals and things that go into the model, and it's about risk levels, okay? So if you get one of these quick sell-offs that rebounds very quickly, your red signal and your green signal can be in a very similar place, okay? So just understand that simple market signals measures risk in the stock market, and as you can see here, these rally attempts, right, because this was red, right, we went red here, so you get these rally attempts that fail, and then it sells off hard, rebounds pretty quickly, and then the signal goes green here, all right? Now, we're going to pick up right here, so this, again, is that transition period right here, all right? So now we're going into 2019. This is calendar year 2019 in the S&P 500, again, daily charts. So this is that red period. The signal went green here. So you can see here when the market is green, this is the best risk-reward ratio for equity investors. And during the green periods, this is where most of your upward progress in the stock market is made. Let's move back and go back to 2007 through 2009, and now we're looking at weekly candles. And what I want you to understand is when the market goes into a prolonged bear market, what really happens here, okay? So now we're going back again. This is 2007. The signal, the weekly signal, when I back tested this, because remember, the model came together in 2017. I worked on this for 20 plus years to figure this out. Finally, all the components came together in 2017. So what we were looking at here, okay, what we're looking at here is actual data. These were the actual signals that the model generated in 2018 and going through 2018 to 2019 transition as we looked here, and then 2019. So this, however, is backtesting. So the original red signal that came out during the bear market that started in 07 and ended at the beginning of 09 came out right here, all right? Again, around 1,500 on the S&P 500. And as you can see, we sold off for a few months. We had this rally attempt that failed and then sold off hard again, bottomed, and the market started to rise, and the signal came out green here, all right? So this is what happens during longer sell-offs, during longer red periods. Your red signal and your green signal have a huge price differential. Just between here and here, the market was down about 40%. Now, if you lose 40%, guys, it takes 66% to get back to break even. All right, so just to get back to 1,500 after if you've got 875 left and you're trying to get back to 1,500, that is over a 66% gain that's going to be necessary to bring you back up to break even. All right, so this is where simple market signals can really, really help during all market phases. But if it can help you minimize your losses during downturns, regardless of whether it's a multi-year downturn that ends up being a super long bear market or a shorter downturn like this, if you can use the signals to help minimize your losses and maximize your gains, right, during the green periods, that is where this thing is really going to help you, okay? So the whole key here, and this is where most people get it wrong, is start with the stock market first. What is the overall market environment like? Whether you're trading the S&P 500 through, SPY or a mutual fund or whatever it is, or you're working in the Dow, or you're working in the triple Qs, or you're trading individual stocks or options, you need to get the stock market right first. What is the environment you're working in? Okay, are you in a green environment? Are you in a yellow environment? Are you in a red environment? Get the market environment right first, and then everything else becomes so much easier after that. As part of the simple market signals model, there are two powerful indicators. There's a risk-based indicator and a trend indicator. As a subscriber to Simple Market Signals, you will receive information on what the risk level is in the overall stock market, as well as what the trend direction is in the overall stock market. So this really, really helps. The way we disseminate the signals to our subscribers is via our weekly emailed newsletter. So within the newsletter, every weekend, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the early bird indicator, the trend direction signal on the overall U.S. stock market. You will have market and sector performance information on multiple time frames. You'll get market commentary and a weekly recap of what happened in the market. You'll have technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information in this newsletter every weekend. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and your first 2 weeks are free. Now let's recap what you get with your subscription to Simple Market Signals. You get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there is a major signal change or direction change, we're not going to wait until the weekend to get that information to you. We will send out a special midweek update when necessary to keep you up to date as to what's going on within the model. And the best fit for a subscriber for Simple Market Signals is somebody that has at least a 6 to 8 week time frame or longer. So if you're a long-term investor, you're going to love this. If you have at least a 6 to 8 week time frame that you focus on with your trading and investing, you're going to love this. If you're an ultra short-term 1 or 2 day trader, kind of a day trader, or somebody that trades within a week, Simple Market Signals might help you a little bit. But the reality is, the people that are going to benefit the most from a subscription to Simple Market Signals are those people that have at least a 6 to 8 week plus time frame that they're focusing on. Also, keep in mind that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. And to subscribe to Simple Market Signals, all you have to do is go out to the website that you see here, https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that simple. If you would like to learn more about Simple Market Signals, I have the following videos on my YouTube channel. I will also leave a link to these videos in the description box below this video. First off is the longest video. It's about an hour long, and it's the Successful Investor webinar. It's the entire story of Simple Market Signals, including my background and why I feel that most people are going to need Simple Market Signals going forward. There's a tremendous amount of market education in this webinar, so I would encourage all of you to go out and watch this because it is extremely educational. And if nothing else, it'll be very thought-provoking when you watch this webinar. So I would encourage you to do that. Again, that video is out on my YouTube channel. I will also leave a link to this video and all of the videos I'm going to introduce here over the next couple of minutes in the description box below this video. Now, if you want something a little shorter, about half an hour long, introducing simple market signals, it has a lot of the same information as the webinar, if you will, but I cut it down to make it fit into a smaller time frame. So still gives you a ton of information. It's just not as inclusive. So if you're not interested in investing the whole hour, which I would encourage you to do so, but if you want something a little shorter but still very informative, introducing simple market signals would be the video you would want to watch there. And if you want the cliff notes, right, you want something that's less than 10 minutes long and gives you more information about the signals and the newsletter, which of course is how I deliver the signals. My proprietary signals within the Simple Market Signals model are delivered in the weekly newsletter. The newsletter has a ton of really valuable information in it every weekend over and above the proprietary market signals. But if you just want to kind of focus on the signals and the newsletter and what's in the newsletter, you'll want to watch the Signals and Newsletter Quick View, as I call it. And then if you want more information about the process, about what it looks like, when you subscribe, when you go out to the Simple Market Signals website, what does that look like? And it walks you through the subscription process and then what you can expect from there. This video will help you with that. And if you want some testing and you want to see some charts, right, in a video format of how simple market signals would have worked in the 2000 through 03 bear market, keep in mind I worked on the model for over 20 years and it finally came together for me in 2017. So this is back testing, but it's very accurate because I was able to just go back, look at the charts and figure out with the model where the signals would have kicked in and where the signals would have changed. So if you want to see the back testing I did on the bear market from 2000 through 03 and how simple market signals would have helped you, the video here, S&P 500 2000 through 03 using simple market signals, is the video you will want to watch. And then I did the same thing for the 2007 through 09 bear market. So again, there's a video on that. I started using the model in 2017, and of course 2018 was a pretty tough year in the markets. The markets were negative that year, and if you'd like to see how simple market signals could have helped you in 2018, I've made a video on that as well. Again, all of these videos are out on my YouTube channel as well as linked in the description box below this video. And if you'd like to know more about my background, I have a video titled My Financial Services Background. It's about 3 minutes long, so pretty quick video, but it will give you my backstory. And I would encourage all of you to watch that video as well. And of course, if you'd like to go out to the website can be found at https://simplemarketsignals.com. And that is the website you will need to go out and subscribe to Simple Market Signals and receive our weekly newsletter, which will include, of course, our proprietary market signals.